Welcome to the daily update, where I'll go over the action in the market for Friday, July 25th, and we'll see how things look for Monday, July 28th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Set another new all-time high, not only for the S&P, but the NASDAQ and NASDAQ 100. The broader market's looking pretty good. We're still seeing sentiment very extreme, and I have some additional charts to show you that it's a little too close to euphoric. And we're coming into a potentially weak seasonal time. But in the meantime, earnings season is being taken as positive, and that's giving the market some support. We are not necessarily falling apart in the middle of July like we did over the last couple of years, but that doesn't mean that things are going to continue to go up. We just want to be careful. We're still looking positive, and that part's looking okay. The semiconductors are still underperforming, which is a little bit of a concern. But when you take it all together, we're positive, but cautious for right now. Okay, so right at the open, we had a higher open, and prices climbed above R1 at 63.76. The pivot points were not really far apart from each other because Thursday's session was not all that wide between the open, high, low, and close, and that's what the Friday pivot points are calculated using. And we got above R2 at 63.89. Then we drifted back to R2. So we just kind of stayed there. We were able to maintain price above R2, and then we closed at R2. So we were up 0.4%, not all that much on a percentage basis, but still an up day. But we dropped back to below average with volume there. And we're positive on all time frames. That part hasn't changed. We're still trending, but we're looking pretty overextended in the short and intermediate, and even a little bit in the long term right now. Not too bad in the long term. We want to keep an eye on that, because the trade news coming out is being taken as positive, and pretty much everything is still drifting over to the positive side of things. So some comments. The S&P, NASDAQ 100, and NASDAQ all set new all-time highs yet again, and that's positive in and of itself. Some announcements were made. The Trump administration will hold talks with China in the next week, while the U.S. and EU could reach the basic idea of a trade deal by this weekend. And so the market's seeing that as positive. Earnings have been optimistic for the most part. There's some that get hammered after they come out with their earnings, but the earnings report themselves have been pretty good. Now, you might see some stocks that see a run up into their earnings announcement, excuse me, and then see some selling after that. But the earnings report tends to be pretty strong. Semis are still continuing to underperform. I have a chart later on to show you about that. Not a major problem, but just a little bit that we look at day in and day out to see, okay, is the overall market climate shifting? All right, here is our list. Now, usually we see the StochRSI, Williams percent R, CCI 14 and 20. They're on the list when we're showing good, positive short-term momentum, even though they're overextended. The stochastics on all time frames, we're still extreme there. The slope oscillator continues to be negative, but it's giving an extreme positive reading. We're seeing a little bit of a divergence with our two short-term oscillators, and I'll show you that chart later as well. We continue to be far away from the 20-period moving average as measured by the boom indicator and the RSI 9 short-term. That is extreme positive. Intermediate term, still kind of a long list here. CMB composite, we're up pretty much into the +4 channel again now with the standard deviations chart. PMO and the momentum oscillators getting a bit of a mixed picture. Some are showing some improvement. Some are actually looking weaker. But some of them, like the PMO and a lot of our momentum oscillators, they're already extreme positive. The Sean trend meter up into the highest area of looking extreme. And now we have the bullish percent index for the S&P. It's above 70. That's also extreme. The percent B, we closed slightly above the upper Bollinger Band. And then we're also far away from the 50-period moving average using the boom indicator, and the intermediate term RSI is also extreme. And we're still looking a little extreme here with the 150-period simple moving average. No change to the scenario. I know Trump and Powell met, and there's some negotiating going on. There's some tactics that are being used here because Trump wants interest rates lower. And it's like, okay, if that doesn't happen, is something else going to change to bring it down so most people can afford homes? So, yeah, there's some negotiating going on with all of that, but no real change in the stance of the Fed. The dollar was up, interest rates were down. We closed at 4.39%. They were up earlier in the session, but they ended up closing down. Things turned a little more positive later in the day. And sentiment is still positive. We're one tick away from being extreme positive, where we had been at 75. Now we tick down a notch to 74. We're still positive with our trend. We're watching the green line with the ADX, both in the short and intermediate term. They're getting close to 40, which would be extreme positive there. And because of the update, the bias is positive, and the momentum, the last 2, 3, 4, 5 days taken together, that has also been positive. Economic reports, we just had durable goods that came out. Now it was down 9.3%, but they expected it to be down 11%. Last time it was up 16.5%. So the previous report, that was like way stronger than expected. So we're coming back down to earth with this report here. When you take out transportation, we were up 0.2%. They thought we were going to be down 0.2%, and last time it was up 0.6%. This is a little bit more in line here. So here's some charts. Year over year, we're still declining here, but we had been showing an improvement on a year over year basis. Then when you take out aircraft, we're still going up. We're a little bit above that 5% level there, and a real drop off because this was a really high reading in the previous month. So we saw that really coming down in the latest reading. Then here, retail sales, we did get this a week ago. And this is trying to attach a trend line to this. I usually look at this in a horizontal way, sideways here. And we are just still sticking to this right now. This is one of the things we want to keep an eye on because it's the recession times are not marked here on this particular chart. But a lot of times before we do go into some economic difficulties, we see retail sales really leveling off and actually going sideways. And we've been seeing that now for quite a while, but we're still not really thinking that we're going to go into a recession, and the market doesn't think we are either. Okay, then margin debt. This is a type of sentiment gauge here. When the market's really going up, people are willing to borrow money from their broker to buy more stock. You get basically 2-to-1 leverage by doing that. And I have a couple of charts. I'll show you the same chart next, but it's a little bit different context. It says, are we near peak euphoria? It's a close call. U.S. re-leveraging to buy stocks has been aggressive over the last year. And it trails blow off tops that we've seen when everybody's just, please get me in the market right now. And this was back in the dot-com boom. And then right before the big great financial crisis, we call that a melt up in asset prices. And we also saw that in 2020 and going into 2021. So we could still go up from here, but we're getting above this dashed line and where it's starting to look extreme. Here's that same thing, but shown in a little bit different way. This compares it with GDP and FINRA. That's the outfit that actually calculates margin debt. It crossed above the 1 trillion mark in June. And then when we compare that to GDP, it remains below the 2021 peak, but above the dot-com and great financial crisis levels. So this is looking a little more extreme here when we look at a ratio basis. All right, then short interest, still kind of high right now on a relative basis. So 2.3%, that's not high in and of itself. Now, when I hit this chart, I usually explain a couple of things. Short interest, first you look at it for what it is. If there's a lot of people who short the market, that means they're going to benefit if we go down. That has been increasing. Right now, these people are losing. But on the positive side, short interest can be a good thing because they had to sell to get in. And if and they have much stricter requirements if they're starting to lose money. They have to get out. And we call that a short cover rally. When the market just seems to be going up and up and up and up and it's out of control to the upside, that's all the people who shorted the market, they're losing and they're having to close those positions out. And they have to buy to get out of those positions. And that's why the market just keeps rising, sometimes out of control here. So it's higher than where it has been, but not necessarily at extreme levels. Now, another thing that is an alternative to this, and this is what I teach in my program and I personally do, there are much safer alternatives than just going in and shorting the market. We have inverse mutual funds, we have inverse ETFs, we have things that take advantage of the market when it is going down, and those are much safer alternatives where you're theoretically your losses are unlimited when you just go straight into the market and short it because there's no limit to how high the market can go. Okay, then here, liquidity index going up with the price here of the S&P, where we're starting to level off here according to this chart on the bottom. And then we look at how we've really been getting overextended here with the liquidity index. The Mag 7 earnings growth expectations. Okay, this just goes back, gives us a little bit of history here. Everything was negative and then it switched to positive. The takeaway from this is you see that there's a gradual decline here. Still positive, but not as optimistic as they had been. Then the FOMC meeting will likely keep the policy rate unchanged. Now, Trump can come out and say what he wants, but really the Fed is supposed to do what the market tells it to do. And I go over this in the weekend video, the weekly update that I do, and I look at what is the market anticipating as far as rate cuts or keeping rates the same. And it's pretty much been consistent that at the upcoming meeting on July, when they make their announcement on July 30th, that rates are going to be unchanged, even though Trump really wants them cut. And okay, he's a businessman and that's his approach, and he wants cheaper money because the U.S. government is having to refinance a lot of debt, and it would be much more advantageous to do it at lower interest rates. But the market itself is still, for right now anyway, anticipating that rates will be left unchanged, but they're still thinking that there's going to be 2 rate cuts before the end of the year. And we'll get an update on that when the Fed makes their announcement on Wednesday. They also come out with the SEP report, and that is a really weird looking chart that where they anticipate how many rate cuts will actually happen. Now, if those 2 rate cuts disappear, or if it's cut down to 1, that could really freak the markets out, because even though they may not cut in July, they're looking now at September. And so when we get that press conference coming up on Wednesday that Jerome Powell does after they make their announcement, if he says, well, we didn't really see a need to cut rates right now, but there's a possibility we might do it in September, the market's probably going to really like that. Even though you have to look at the context for why they're raising and lowering rates. Are they raising rates because inflation is a problem and the economy's chugging along too fast? Okay. And that could be good. You can see interest rates going up while the stock market goes up and the economy's doing better. But once it gets a little overheated, that's when things start to get scary. The same thing is true with rate cuts. Why are they cutting rate cuts? Is it because the economy is doing okay and they just want to kind of add some more fuel to help it do even better? Or is it because the economy is falling apart and they need to try to stimulate the economy because there's real trouble on the horizon? All right, and then relative performance of new additions. Now, I have a video on this that's on the YouTube and Rumble channel. I also teach this in my class, that to be a member of the S&P 500, you have to meet a series of criteria. They don't just let anybody in there. And I've heard people slam that. It's like, well, yeah, the indexes are holding up better, but individual stocks are worse. I actually think that's an advantage, and that's why I focus on the S&P 500, that there is some layers that have to be met for a stock to be included in the S&P. And if you don't meet those, you're dropped out of the index. Well, here are some new additions that actually meet that criteria. And how have those stocks ended up performing? And a lot of this, usually they perform pretty well, at least when they're, and you can see a bit of a run up before it gets added and then it drops off. And then sometimes we see a little bit of a downward move after they're added because now money managers who are trying to mimic or copy the S&P 500, they have to buy these stocks too. And they're usually when a stock is not in an index and then it's added to the index, that's usually taken as a positive thing. Where a stock is in an index and then it's taken out, that's usually seen as a negative thing. So that just calls for some of the adjustments to be made according to portfolio management. All right, then tech stocks stage massive comeback from April lows. This is just how has everything performed? Apple, Amazon, Google, Meta, Microsoft, Nvidia, Tesla. Since this is at the beginning of April, we actually set the bottom on April 7th here. But how have they been doing? All of them have been doing quite well with Nvidia leading the pack, but you still have Apple that hasn't really regained where it was at before. All right, money supply growth has recovered to its long-term trend in the US, slightly lagging of late in the euro area. So this is one of those reports. It's great for telling us what we should have known, but we get this report so late that it's really hard to make real-time decisions based on this. But we still want to know this anyway. And just how has M2, which is the money supply, how has that been behaving when we compare it to the euro area? Instead of EU, they call it the EA here. All right, and then non-profitable tech. This is when we see signs that, okay, even tech companies that aren't making any money, we want to buy those anyway because they could start making money. All the stocks that are making money, we've already bought those. Now we want to go over and buy some stocks that, are dogs here that are underperforming. And when we see them really starting to perform well, which is what they're doing here, they get a little nervous over that. This is shades of the dot-com boom back in the late 90s where you had people wanting to own all these dot-com companies that didn't even have any earnings yet. They didn't even really have an office yet, but yet they had their stock went public and people were millionaires, at least for a little while until all that evaporated. But this is when you get a little too much euphoria going on in the market. All right, high, low, short interest. Also showing up here, we may be moving towards the later innings of a short covering, given the magnitude of these moves. Okay, just showing that's kind of going hand in hand with the previous chart that I showed. Earnings growth expected to pick up in 2025, and that's why people are happy looking out into the future. You can see the estimates going out for the most part are going up, and that's what drives stock prices, is higher earnings. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Okay, here is the intraday chart. Not much of a change at the open. We did have a positive open here, and then it looked like, okay, maybe we're going to have a really boring day. Not a lot of gyration right after the open, but we did get above R1. We held on to that, just kind of drifted sideways, and then we were able to get up to R2 and actually get above that. This is when things started to shift over and look more positive in the afternoon. So we did see some buying coming up here, and we held up above R2 for most of the session, and we closed pretty much at R2. When things were said and done, a little bit of an uptick as the futures get ready to close for the weekend. We're seeing pretty much even right now with the intraday growth versus value. We'd like the blue line above the red line, but if they're both still going up, that's positive in and of itself. And we did see a bit of a pullback here. When we saw the thing switch over a little bit more positive, it was more value. And that's what we've been watching. Not really seeing any evidence of this in the price charts itself, but periodically, right at the beginning of July, we saw this ratio really coming down. That was a value outperforming growth. Then we saw earlier on here another day where the growth to value ratio really went down. And here we were doing pretty good, but then we gave a lot of those gains back. Is this the market, the smart money in here, starting to position themselves in case we run into some problems in August and September? It's pure speculation. This is just a hypothesis at this point. We're really not seeing any evidence of that. But that's why I look at so many charts and look at so many different things. We want to pick these things out and at least know about them before they happen so that they don't hit us by surprise. Okay, here is the end of day chart where growth was up more than value for the large caps. It's up quite a bit more here with the mid caps. That really improved, and up a little bit more here with the small caps. So our growth to value ratios with the small caps just kind of chopping along, but it did improve in Friday's session. Actually starting to break out a little bit here with mid cap growth to value, but the indexes are not really, they've been doing a lot of sideways action. They're looking a little bit stronger here, and they have improved since the April lows, but not showing the strength that the bigger indexes have been showing. Setting another new high here with S&P growth to value. Now that's positive, and we're breaking out here. And that's boding well for the S&P 500. We did tick back up a little bit here with the growth to value ratio between these two ETFs. And we're still doing okay here with discretionary to staples. This has been lagging a little bit, but it has been improving enough to give us a recent golden cross here with this ratio. So this is looking better. And we are setting a new all-time high with the large cap growth ETF. We're up 0.5% there. And this is what we're watching for. This is the short-term ADX, the short-term trend, and then how we analyze the trend. We're getting really close to this 40 level with the green line. That's the dashed line here. And if we get above that, that means we're getting extreme. And a lot of times we get close to this level, and then you can see then we start to turn down after that. Doesn't always mean a big reversal, but it just also points to the idea that maybe we're getting exhausted. Also, a little bit further away here with the intermediate term ADX, but the green line is also getting close to that 40 level. And we dropped down below average with volume. We had a gradual pickup in volume throughout the week, but in Friday's session, we dropped to below average. And then looking at sentiment, because people are like, the market's just magically going to keep going up. It's a cash machine. I'm just going to continue to put money into it. So the so-called sentiment gap is now the widest since the pandemic. I don't like it when they do these, since 1992 or since 1946 or something like that. If you exclude the pandemic years, okay, I don't like to do that. We should look at all of the data that's there. It's the biggest gap since 2011. This is just showing that we're getting a little too euphoric here. When you look at the spread between sentiment and the hard economic data. The hard data, those are the reports that come out. The soft data is like, well, I'm feeling more positive. That's just how people feel about things. And that's like, that can change even hour by hour, but usually day by day, where, okay, is the market looking more positive or is it looking more negative right now? And so there's a measure of the distance between the two of how people are feeling versus the actual data coming out. And it's getting down to a pretty low reading right now. Here, another sentiment composite. Now touching extreme optimism. Would be logical to see the market cool between mid-August and mid-October. Okay, that's what we've been watching for. Now, the last couple of years, it started about halfway through July. Hasn't started yet. Is it going to happen in August? We don't know, but we just want to be ready for that. And if we look at setups to what has happened before, we're seeing a rather similar setup right now as far as sentiment with all of the gauges that we look at. Okay, so, and this is one of those gauges here. We're continuing to drop here with the VIX well below 20. That is positive. Also dropping with the VIX of the VIX. So the volatility of the VIX is continuing to go down, even though we closed up a little bit here on the line chart. And we dropped down here. So the skew index was anticipating an upward move. Apparently enough of it happened on Friday. And so people are closing out those call options. That's what conclusion I was reaching here. And now we're dropping back down out of the red area. So could this mark a top? Yeah. Could it mark a bottom? Could we continue to go in the same direction? We don't really know that. We just know that the market was getting pretty excited about it going up, and now this skew index has actually dropped back down. We did decline with this fear gauge. We also ticked down a little bit here with this other fear gauge. So with the up day, we're still seeing more fear coming out of the market, but we saw a really big upward move here with the equity put call ratio. Is it just some pre-weekend hedging? I don't know. But an awful lot of puts were bought on Friday, and that's causing our 5-day chart to go back up and our 10-day chart to go back up. So this is just some concern out there when we're seeing more puts than calls. Now, you could also say, if you go back to the first chart, that maybe a lot of the calls from the skew index, those got sold. And when you look at it all together, more puts were purchased than calls because a lot of those calls were sold. Okay, that's another way of looking at that. Okay, and we're still going up here with the risk on to risk off ratio. When this is going up, that is more positive. Still getting a quite a high, excuse me, quite a high reading here with volatility risk premium. This is anticipating some fear looking out into the future, about 30 days. Advanced decline line though, setting a new all-time high based on price and volume. That's positive. Above zero and going up with our, excuse me, with our 10-day advanced decline ratio. That's positive. And we're going back up after we saw a little bit of a decline previously here with the advanced decline ratio. And not a real breakout in the new highs, even though we're setting new all-time highs with the S&P, but this is still pretty healthy. So we're going back up with our 5-day moving average chart and our 10-day moving average chart. And looking good here. Now, the other smart money indicators are not looking all that good, but accumulation distribution above an advancing moving average, and the boom indicator has turned back up. But we are above this red line, which means we're getting rather extreme with this reading already, where we're actually going down now with the chicken money flow. We saw the histogram dropping over the last 2 days. That's a bit of a negative divergence there with the S&P setting another new all-time high. And we're still declining with the chicken oscillator. So even with the up day, 2 of our 3 smart money indicators continue to decline. All right, but we did improve here with the vortex. Green line going up, red line going down, above all of the moving averages, which are advancing here with the different indexes with our advanced decline line studies. Above zero and going up with the broad market measure of the 5-period moving average of the highs minus the lows. A little bit of a tick up, but not a huge improvement here. With those stocks above their 20-period moving averages, you could make a case. We're going up with the S&P. We're so far setting a lower high with this particular indicator. That could be considered a negative divergence. Also, a little bit of a tick up, slight negative divergence here with the intermediate term based on 50 periods. And we were flat with the 100-period moving average study and ticking up a little bit as well. Now, this is a little stronger because we're setting a series of higher highs here for the most part. So this is looking a little bit better. And then we did get above this dash line. We actually got a little bit above that throughout the week. And so far we've been able to hold above that. We also dropped down to below average with volume. A little bit of a tick up with the 20, 50, and 200 period moving average study. This is right on the S&P itself. And then our short-term indicators, the StochRSI showing good positive short-term momentum, as is the WIMS %R, CCI 14, and CCI 20. All the stochastics charts are extreme positive on all different subdivisions of the short-term time frame, but they're positive but looking extreme. And we did get back slightly above the midpoint here with the force index. That's positive there. The short-term trend is measured by a double and triple exponential moving average based on 20 periods. These lines are continuing to go up. They're not very far apart from each other, so we've been slowing down a bit, but the line's going up. That's positive in and of itself. And we're actually above the +3 channel, so we're into the +4 channel now with the standard deviations chart. Now, we were a little bit concerned here. We were going up with the S&P, but the balance of power was actually going down. That was a negative divergence. It did improve in Friday's session. Still looking good with the 10, 20, and 30 period moving averages here. All the lines are going up and prices above all the lines. Looking extreme with the CMB composite and not rolling over yet. Positive with the darker blue bars when we look at the go, no-go system. Still getting a little long. We started that at the beginning of July. This is more time, but we're positive because these green lines continue to be drawn in day after day. And we're also positive here with the dark blue lines getting drawn in day after day. But we're seeing still a negative divergence here. The TTM squeeze is going down and is actually negative where the S&P has been going up. Still flatlining. We haven't seen this change to going really in any kind of a convicted way here. You have to go back to May when this was happening. But we're positive with the ease of movement, but we're just trailing along this zero level here, slightly above it. The Arun indicator continues to be positive, more buyers, less sellers. That's why the oscillator goes up. And we're above zero still with the S&P 500 McClellan oscillator. So when that's above zero, whoops, I got these out of order. We're a little bit below zero with the NYSE McClellan oscillator, even though it improved. So we're still going up with the summation index based on price and volume. That's positive. But we're continuing to go down, just kind of sideways right now, a little bit higher based on volume when we look at the NYSE. So a little bit weaker action here with the broader market. We did turn back up with the Swinland trading oscillator based on price and volume after they had been declining. And we're still getting an extreme reading with the PMO. We're trying to turn back up, but we haven't quite crossed above the moving average. But we're breaking a little bit above the moving average based on price. We're a little bit below the moving average based on volume. So we're above 50 and going up at the PMOs that are rising, above 50 with the buy signals, and still getting a nice high reading with the PMOs above zero. Positive with the Elder's Impulse system and positive with the parabolic SAR. Still negative, trying to turn up here with the slope oscillator. This is where we're seeing some divergence here. We're still above the green line, so that's why it's extreme, but we are negative since we're declining below the moving average. The MACD is trying to improve, but hasn't quite crossed above its moving average yet. So here, in the short term, we're going down with the slope oscillator, but we're going up with the TSI. That's why I use more than one of these. So this is not really confirming each other. We are improving with the intermediate term, but these are pretty much flat. And we're also flat with the long-term tricks and KST momentum oscillators. Still negative with the Copic curve. Extreme in the dark green area here with the Sean trend meter. And then some secondary indicators. The money flow above 50, as is the ultimate oscillator, even though it ticked down slightly. Above the advancing moving average with unbalanced volume. Looking extreme here, we closed above the upper Bollinger Band. And you can see here the bands are starting to get a little bit closer to each other. We were getting close to each other here, and then we saw a breakout to the upside. They're starting to get close together again as we've been chopping sideways with a general upward drift here. Is that going to produce another break to the upside, or is there going to be a break to the downside from this? Still extreme with the intermediate and short-term RSI. Still looking good with the intermediate term trend. We're below the red line, but both the red line and the blue line continue to go up. Above all the plotted moving averages, and the moving averages are going up. That's positive there. Far away from the 20 and 50 period moving averages as measured by the boom indicator. And getting above 70 here with the bullish percent index. Now this is positive since it's going up, but we're getting extreme. Now, it could go higher than where we're at right now, but it doesn't have an awful lot of room left to run to the upside. A little bit of an improvement with the NYSE bullish percent index, and we did improve, and we're not extreme with the NASDAQ 100 bullish percent index. So we were up 1.46% for the week, and we're still looking pretty good here. We're hitting right below this R1 pivot point. This could be longer-term overhead resistance. So we want to keep an eye on this if we start to hit this. And if you wonder if these are important, just look at other times when we hit these previous pivot points, and that's when the market saw a pretty big turn going on here. So we'll be watching for that. We are positive, though, on a trending basis with the Heiken Ashi looking positive. The Keiki chart is positive, the Renko chart, and the three-line break. Those are all positive there. We're still looking extreme here when we look at the 150 simple moving average. Still looking positive, but not extreme with the 200 period moving average. Positive on all time frames with all the different indexes. We switch back to positive here in the short term with bonds based on price. I've actually switched to short-term negative with commodities. This has been a bit of a concern. Commodities were positive across the board. Now we're looking a little bit more weaker here. The dollar continues to be negative on all time frames. And the intermarket analysis video that I do over the weekend, it looks at the CRB index and does some studies on that. We saw energy and communication being down. That's a little bit disappointing because communication is a growth area. Materials have been doing quite well. Discretionary had a pretty good day. Tech did okay, but not great. Everything was green here. We had a BPI cross above 70. That's the chart I just showed. The NASDAQ got above 21,100, also setting a new all-time high, as did the NASDAQ 100. S&P setting a new all-time high, and Canada set a new all-time high. And so not a lot of strength in here, but not a lot of weakness either, where Apple was up a little bit, Nvidia was down a little bit, Microsoft was up over 0.5%. That's the tech sector. Discretionary, Amazon was down. Tesla bounced after getting smacked over 8% on Thursday. It was up 3.5% on Friday. Google was up, Meta was down. So not a lot of conformity across the different sectors. We are still seeing a general improvement with the equal weight coming back up to the bar chart, which is the weighted version of the S&P. That just shows there's more broad participation. And we got a little bit above this pivot point here with the Dow, but not really setting an all-time high, but it's still looking positive here. We've gone from neutral back over to positive with the diamonds, and we are setting another new all-time high here with the NASDAQ. It was only up 0.24%. We actually, on an up day, we switched from positive over to neutral, according to the Elder's Impulse system. We did get a little bit above this pivot point here with the NASDAQ 100. This, I've been pointing this out. We were dealing with that. That could be positive that we're breaking above that. And we're still positive with the QQQs, looking at the Elder's Impulse system. But the momentum, as measured by the PPO, it continues to drift more negative. And we're also dealing with this longer-term trend line on a weekly chart of the NASDAQ 100. We're starting to break a little bit above this trend line, which we did before. But this could suggest there's some exhaustion coming in. We're still above the 200-day moving average with the S&P 600 small cap index, and just kind of chopping along sideways here with the Russell 2000 small cap index. And we're still neutral with the small caps looking at the Elder's Impulse system. A little bit of a break higher here, getting close to a golden cross with the mid caps. And we've gone from neutral back over to positive with the Elder's Impulse system for the mid caps, setting a new all-time high with the broad market Wilshire 5000. That's, of course, positive. Also setting another new all-time high with the total U.S. stock ETF. Financial sector was up 0.7%, still continuing to underperform the S&P. It's not even back up to its 200-day moving average when we do a ratio of the financial sector to the S&P 500. The FANG index was actually down a little bit. Not an awful lot of strength with the really big stocks in Friday's session. Apple was up slightly, and Amazon was down 0.33%. Microsoft was up over 0.5%, setting, I believe that's a new all-time high. If not, it's really close to it on a closing basis. It did set an intraday all-time high, though. And Google was up over 0.5% and seeing a recent golden cross with this. Meta was down 0.3%, still above its 50-day moving average. Nvidia, virtually unchanged and in an uptrend as well. Tesla gained back 3.5% of the more than 8% that was lost on Thursday. And Netflix still continues to see some weakness here. This has been holding up better, but lately, not really holding up as well as it had been previously. This is the ratio that we're looking at here. This is the semis to tech ratio, and it continues to go down. We want this to go up. Now, it's not falling apart. It had been rising up nicely, but if we're more positive, we want to see this ratio going up, not going down. And then looking pretty strong here when we look at U.S. versus world stocks in a short-term correlation, leveling off after declining slightly with the long-term correlation. Oil was down right in the 65 level here, still in a downtrend with the dollar, even though it bounced up. Latest reading from Truflation coming in at 2.02%, where last week we had CPI come out at 2.7%. We did come down with interest rates, but we still want to keep an eye on this red line, which is the 4.5% level with the 10-year yield. And we're still above the 50-day moving average with the 10-year based on price, showing a little bit of improvement with momentum, but not quite crossing positive. We're slightly above 50 with the RSI. And we're dropping down a little bit here with the Qs to S&P ratio. It just shows that value outperformed here according to this particular ratio. But overall, this has been fairly solid. We improved, but we're still below the moving average when we look at discretionary to the S&P. And when we compare large cap growth to value, this is bouncing up again above its moving average. So we're above the moving average with the large caps, mid caps, and small caps again. That's showing some improvement there. We're continuing to decline with the staples to S&P ratio. When this ratio is going down, that's more positive for the S&P. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. So what's the outlook? We're still dealing with earnings season. We had a lot of companies report this past week. There's still going to be more companies that report in the upcoming week. We're positive on all time frames, and we continue to be trending, but we're watching the green line with the ADX to see if it's going to get up to that 40 level. We don't have any economic reports coming out in Monday's session. Now, it's going to be a heavy week, but not on Monday. So that's kind of like a day off in a way. So action might be a little slow in anticipation of the big reports that will be coming out later in the week. And then anything geopolitical, whether it involves the trade wars or tariffs or some announcement from the White House, and then any kind of escalation between Russia, Ukraine, Israel, Iran, India, Pakistan. There's a lot of things for the world to be concerned about right now. Here is the economic calendar, where nothing on Monday, but then we're going to start getting jobs data. We'll get consumer confidence on Tuesday, and then the JOLTS job openings. And I have that in gold just because we're really keeping an eye on all the different measurements that we use for how does the job market look. We're going to get the first reading of second quarter GDP. This is the first time we're seeing this one. That could be a big deal. And then not long after that is when the Fed's going to make their rate decision announcement. And then there'll be the press conference after that. And then we got a pretty heavy day on Thursday with initial claims, which we've been watching closely. We're going to get PCI prices and the core PCE, here, as well as the employment cost index. These are some major reports coming out all on the same day. And if that's not big enough, we get the big employment report on Friday, as well as ISM manufacturing and consumer sentiment, all in the same day. So this past week was kind of light with economic reports. Monday has nothing, but the rest of the week is going to be pretty significant. Okay, and then this also looks at the upcoming calendar for the new week. Seasonality, neutral to negative for July 28th. We're now past options expiration week, the week after options expiration. But nothing really significant here. Neutral to negative with the Dow, S&P, and NASDAQ. And not too bad when we look at just post-election years with the post-election years. Green dashed line. See a little bit of weakness here before we can often see a bit of a bump going into the latter part of the month. Second half of July does underperform the first half. And that's also shown here with the Carson chart. They also show a little bit of a move up here as we finish out the month of July. So I'm still keeping the smart money indicators on the negative side here. Accumulation distribution, that's positive. But we're looking extreme with the boom indicator, where the Chaikin money flow and the Chaikin oscillator are negative. The McClellan oscillator for the NYSE and summation index, those continue to be negative, where the S&P is positive. And I'm keeping the momentum oscillators over here on the negative side. The copy curve is clearly negative, where we're getting more of a mixed picture with the S&P oscillators. And the momentum for the NASDAQ 100 continues to drift lower. And the long-term special K chart, which I'll go over in the weekend update, that still continues to be negative, and we have a long-term Zohorchak method sell signal. Positive side, though, still looking good with our growth to value, discretionary to staples ratios. As I mentioned, the S&P McClellan Oscillator and Summation Index, they're above zero. They're going back up now. The parabolic SAR is positive, and we're extreme with the bullish percent index for the S&P, but we're still positive with the NASDAQ 100 and NYSE bullish percent indexes as well. Swinging trading oscillator was on the negative side. Now it's switching back over to the positive side. And then some secondary indicators here. The ease of movement, money flow, and ultimate oscillator are positive. The vortex, which I count as a primary indicator, continues to be positive. The financial sector is positive. It's just underperforming the S&P. Then here are the pivot points for Monday's session. So the conclusion, no changes. Positive on all time frames. We're still trending, looking a little extreme at this point as far as sentiment. So, and I'll be analyzing that even more over the weekend, and I'll be looking at growth to value ratios as well. So thank you. I hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.